this computer, and we just do a short recording. You can always find it in YouTube later on. And I'm going to share my screen, and there we share. There we have it. Full screen mode. There we go. And welcome to this week 8. And this is chapter 11, financial statement fraud. And I think the big ideas that I've always tried to impress upon the students were, what were the money slides? Maybe there's a money slide for each week, but there was two big ones that we've introduced. The first one in the first 3 weeks, two big circles, creating a culture of honesty and preventing fraud opportunities. And the second one was more the vulnerability matrix, and that was really a spreadsheet. It is basically a step-by-step checklist for you to go through when you're investigating fraud. All right, so if we get to the financial side of things, is there a money slide? I would think the big money slide would be, let me find it for you, and here we go. This is the money slide, and I don't want you to worry about all the little parts and all the other feeder mind mapping, but look at the 4 big areas. In the textbook, that is basically shown in terms of the exposure to fraud, the likelihood of fraud, of financial fraud, which is the largest out of all of them, like fraud due to corruption, fraud due to asset misappropriation, everything you learned in the first 6 weeks on asset misappropriation by employees, by lower level management, that's nothing compared to the losses shared by financial statement fraud. And this is fraud against a particular victim, the shareholder. Whereas asset misappropriation, the victims are the companies themselves. This is the shareholders, the owners of the companies, that the management, senior management, the CEO, the CFO, are perpetrating to line their own pockets. And so the big question is, when we get to chapter 11, is, well, what do we do? If the CEO is in charge, then how do we do the A, B, C, D, E, F symptoms that we learnt in week 3, week 4? You can't. They can manipulate any part of those symptoms. And of course, they should have an extravagant lifestyle anyway, because they must be earning millions of dollars already. So you cannot say that, oh, the CEO's got Mercedes-Benz, he must be committing fraud. No, for an employee maybe, but not for the CEO or the CFO. All right. So the C-suite managers, you don't have that same toolkit of symptoms to look at to see if fraud is being committed. So if you don't have that, is there a replacement? Well, one part of the replacement is to think in terms of how they are pressured to undertake fraud at the financial level. And one may be how they work with management and directors. So are there loopholes in the management, no independent board of directors and less diversity and things like that? Or maybe they have relationship with others that enables them to do the round tripping, which is a form of financial fraud. Maybe it's the organization and industry that enables a particular fraud to take place. And maybe it's the financial results and operating characteristics of the firm that force some fraud to occur, like decline in profits, but you promised higher returns. So then you get into manipulating sales that are not there in order to satisfy the analysts and the shareholders. Well, in the short term anyway. All right. So this is some kind of like a symptoms map, but it's much more of an exposure. It's the likelihood of fraud happening can be attributed to these four areas: financial results and operating characteristics, the the setup of the management and the board, the way the organization is set up and the industry, and also the relationship with others. These all factor in to whether financial fraud is being committed. And so the last thing I want you to take away from chapter 11 is, well, what's the simplest way to commit, say, financial fraud? Well, the simplest way is to manipulate revenue. Sales. How do you make sales higher? Of course, you're going to credit sales. You know that from first year. But what do you debit? What do you debit? And I can ask the class. Yesterday they said, oh, won't you debit cash? No, 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 no. Don't touch the cash. Why? Because the cash has a perfect audit trail. You cannot hide anything when you play around with the cash. You will be found out. So don't touch the cash in accounts. What about inventory? No, no, no. Don't touch that, because inventory has a physical audit trail. All right. If you say you have 1,000 boxes of an inventory item, then the auditor is going to go and look for, where are those 1,000 boxes? You know what I'm talking about. All right. No, the best way to hide that debit is to put it into accounts receivable. And that's the most popular way, because the auditor 12 months later say, oh, how come the accounts receivable seems to be less than what it was at the end of last year? And you can say, oh, forgot to put this in. One of our creditors went bankrupt. One of our debtors, they owe us. They went bankrupt, and so we had to write it off as a bad debt. Oh, or you could say, oh, look, they were very slow on paying, and we had to give them a 20% discount for them to just pay and settle the accounts receivable. That's why we only got 20% less than what we booked. And so there are many different ways of actually watering down that debit that is created when you inflate sales. Now, of course, that's the easy peasy and the perfect way. But another way of thinking about financial fraud is in thinking in terms of three different boxes. The first box is where you manipulate sales by having a relationship with another party. So you do round tripping. You say to the other party, let me book sales to you, and then you can book a sales return to me. And you basically inflate each other's sales, but no transaction takes place. That's called round tripping. Or the middle type of sales fraud, which is very popular, is you just alter the sales in the last 3 or 4 or 5 days of the financial period. And that is, you bring forward sales that you know you're going to make in 1 week or 2 weeks' time, but you bring it forward into the current financial year so you can make the current profit look very nice. And so, the first box is where you actually you kind of fraudulently set up relationships with other entities to actually make up sales. The second box is where you manipulate the accounts through debits and credits. And the final box, the third box, is just outright fraud, where you just inflate sales without any doing of any other stuff. All right. So think of it in terms of that way. What you've got here to take away is, this could be a third money slide, because the symptoms start on this page. Okay. The other thing to take away is the fastest and neatest way to get away with a sales fraud is to credit sales and debit accounts receivable. And finally, just think of those three boxes where you physically inflate sales by masking funny contracts with other organizations. You manipulate the accounting, and the final one is a total sham sales. And three different types of approaches you can go into manipulating sales. So there you go. Financial statement fraud, the cleanest and simplest way to work it is to focus on the sales. Keep away from inventory, keep away from cash, sales, and accounts receivable. There you go, easy peasy. Thank you. And this is the big idea to take away from chapter 11. Okay. All right, we're just going to stop sharing that. And we're going to stop the recording.